The Fed's preferred measure of inflation cooled again in December, raising hopes for a Fed pivot on interest rates. But recession fears persist. How should investors prepare for 2023? Joining me now from sunny Santa Fe, New Mexico, Thornburg Investment Management CEO Jason Brady. Jason, thanks for coming on the show.
It's a pleasure, Jack. Thanks for having me.
So, look, I'm as guilty as anyone of using the word unprecedented too much and treating current markets as if they're some kind of anomaly. But in your recent CEO's Perspective note, you actually made the case that we're returning to normal. Can you explain that?
I think that what we've seen and what we've experienced really over a decade plus since the global financial crisis has been central banks really providing a lot of support to markets, and that's resulted in very low yields, particularly real yields, and actually relatively elevated multiples, particularly what we saw post the pandemic. So 2022 was unprecedented from a price return standpoint, but really what we did was we normalized. We normalized back to positive real yields, which is great for investors, and really back to kind of averages, at least at the index level for U.S. stocks.
Which is actually pretty good news going forward for, say, a 60-40 portfolio. Here's another thing that unfortunately is normal, which is what my colleague Jack Howe likes to call the game of debt ceiling chicken. We're going to hear a lot about the debt ceiling and the possibility of a default. But you've done something which I hadn't seen before, which was you actually quantified the impact on GDP if the government shuts down. Now, I'd love to hear about that, too.
It's really a function of what are government payments and how do they affect GDP. The reality is government payments are important, but I think the underlying reality and why we don't believe investors should be particularly concerned about the debt ceiling is I'm not sure there's a single member of Congress that wishes to go back to their constituency and say, you know what, you're not getting Social Security, Medicare's broken because I took a stand on what ultimately is a procedural issue.
All righty, so where does this all shake out when it comes to stock market valuations? You mentioned they've come down. Are they cheap enough yet to be of interest?
Well, they're normal, as we talked about. They're average. So what we have the opportunity to do now is determine whether the fundamentals of the companies that we may invest in the context of their earnings progression over time, provide any value. And what we've seen early in the earnings season is that while financial services, particular banks, have looked pretty good, industrials are having a bit more of a challenge. In particular, names this past week like 3M announced some real challenges. That said, ultimately, U.S. equity index level valuations are driven by some of the largest caps, and those tend to be big tech names. So it was really earnings from Microsoft that were perhaps the most interesting. What we're thinking about is Microsoft a tech name? Yes, of course. But should we value it as a high growth entity, or should we think about it more as a high quality entity, something more akin to, say, Procter & Gamble?
Gotcha. Let's look overseas. Valuations are certainly a lot cheaper on the one hand. On the other hand, I can't name a whole lot of French Googles and German Amazons. So the rap is it's just not an innovative enough economy. Is the price low enough to justify that?
I think that actually is a point today, anyway, in favor of those markets, which is to say, when you saw tech leading the way globally, then it was a real negative to not have Google and Microsoft, or even more importantly, in some cases, money-losing tech names, which really were driving some of those fantastic gains in 21. What you're seeing now, and really what you saw in the course of local currency returns in 2022, was that some of the more basic blocking and tackling names are not only cheap, but they're actually growing revenue. It's actually tech that's a bit of a lodestone for the markets here. So valuation is very good. Like for like businesses, let's say integrated oil in the US versus Europe, Europe provides a better outcome. And so the margin of safety is interesting. And for us, that means it's a target-rich environment.
All right, we're almost out of time, but before I let you go real quick, Thornburg is known as a bond shop. What's your fixed income playbook for 2023?
Well, we have real yields now that are positive, so that's great news. While spreads are not that interesting, it's really both consumer and corporate balance sheets that are higher quality than sovereign balance sheets. All in, we're seeing from our clients a big move into fixed income, and the reason is they're able to get returns and have that 60-40 ballast that you described, for the first time in well over a decade.
Well, that sounds pretty good. Jason, thanks so much for coming on.
It's a pleasure. Thanks for having me.